Zach's Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Well, this time around, we're going to talk with our chief options expert here about how to profit with an Iron Condor strategy. I didn't wear my ninja outfit for this because I didn't know we were going to do this, but Kevin Matras seems to know all about this strategy. So I have to admit, Grasshopper, I have not heard of this one before.
I thought for sure you would have heard it. You know, what's interesting is that whether you trade options regularly or not, a lot of people have heard of this strategy, but I can probably assure you that most people have no idea what this even means. And it's interesting because while people have heard about it, this is kind of like the Bigfoot of option strategies, right? Everybody hears about it, but nobody has actually really seen it. But again, I can assure you it's real, and that is what we're going to be talking about today.
Well, I strike out on both counts. I haven't heard of it, and I have no idea what it means. So let's start with why someone would want to use this strategy.
Okay. First off, the Iron Condor is classified as a neutral strategy. So, for example, if you are bullish on a stock, you're going to buy a call option. But again, you are making a bet that the market is going to go up. If you're bearish, you're going to make a bet that the market is going to go down. Typically, you'll buy a put on it. But for this strategy, you're not really picking a direction per se. You are basically trying to identify a range. So, if you get in and the stock goes up by a certain amount or down by a certain amount, or let's just say sideways, you can profit. And in each one of those three scenarios, as long as it stays within that range, your maximum gain would be exactly the same in either one of those three scenarios. The other thing about this is that it is a very low risk trade. It's a relatively low reward trade, but you have a very high probability of success. And the other thing too is that you would generally put this kind of strategy on as a credit. So you're going to be a net collector of premium. You get paid to put this trade on for yourself.
All right, so that said, let's have you set this up for us slowly.
Right, all right. The best way to explain it is to go over a trade that I actually just put on. I did this a couple of weeks ago, and I'm going to use Apple as an illustration. And I put this trade on shortly after they reported earnings. So they had a great quarter, but they did miss expectations, but they surprisingly guided above views. So I kind of figured we were going to trade within a range for the next couple of weeks to the next few months. So I put this trade on, so let me set it up, all right?
All right, sure.
All right, so here's what I did. On October 21st, 2010, when Apple was trading at $3.95, I bought to open 1 December 2011, $425 call at a premium of $741, which was a $741 debit because I bought it, okay? Then I sold to open 1 December 2011 420 call at $885. I received an $885 credit. Two more things to this trade. I ended up selling to open 1 December 2011 370 put at $950. That was a $950 credit.
Okay.
And I bought to open 1 December 2011 365 put at $833, that was an $833 debit. Now essentially, an iron butterfly is comprised of two credit spreads. You have a credit spread on the call side and you have a credit spread on the put side, as you can see illustrated on this slide. So we received a net credit of $144 on the call side, and we received a net credit of $117 on the put side for a combined net credit of $261. Now, when you're doing this kind of trade, your maximum gain is always going to be limited to the credit you receive. So again, our maximum credit is $261, and as long as Apple stays within that range, which would be the inside strikes, the 420 and the 370, as long as it stays within that range, we would receive our maximum profit, which would be that $261, so it's a $50 range. The maximum loss is $239. And the way you would see your maximum loss is if it closes outside of the further out strikes, which would be above 425 or below above 425 or below 365, okay?
So give us an example then on how you would win with this.
All right, so let's go to this next slide and let's illustrate this. Let's say, for example, Apple closes at 420, okay, at expiration. That's going to be the third week of December.
Okay.
That means the 425 call that I paid $741 for would expire at zero for a loss of $741. The 420 call that I collected $885 for would also expire at zero, but that means I kept the entire $885, so that would be a net gain of $144 on the call side, okay?
All right.
Now going to the put side, the 370 put that I collected $950 for would expire at zero, meaning I would keep the entire $950 that I wrote. And the 365 put that I paid $833 for would expire at zero, but that would be a loss of $833. But as you can see on this slide, that would still result in a net gain of $117 on the put side. Add both sides up, and that would be a $261 gain. So once again, whether it expires within that range on the high side, the low side, or anywhere in between, your gain is going to be exactly the same, which would be that $261. But again, when you're looking at your loss is outside of the further out strikes. Now, the way you would define your loss is you take a look at the largest spread on either side. In this case, it's $5, right, because we have a 420, 425 spread and a 370, 365 spread. Mm-hmm. We are the same on either side. But in order to determine your max risk, you take a look at your largest spread on either side, less your credit, and that is how you can determine your reward to risk ratio, and that is how we get our 261 gain to our 231 or 239 loss, okay?
All right, I think.
Well, here, the better thing for me to do is let me illustrate how you can lose on this, okay? So check this out. So, let's say at expiration, Apple closed at 364. That means the 425 call that I paid $741 for would expire at zero, which means I would have a loss of $741. The 420 call that I collected $885 for would also expire at zero, meaning I would keep the entire $885. So it's the same as the first example so far. We have a net gain of $144 on the call side, okay? Mm-hmm. As for the put side, the 370 put that I collected $950 for is now in the money. It's in the money by $6, meaning I only kept a profit of $350. $950 minus 6, that's $350 gain. The 365 put that I collected $833 on, or excuse me, paid $833 on, that is also in the money, but it's only in the money by $1, which means I was able to mitigate some of my loss, but I still had a loss of $733. Okay. So on the put side, that is a net loss of $383. Add all of that together, and you have a $239 loss, which is what we said at the top. Yeah. You had a $144 gain on the call side, $383 loss on the put side. Your max loss is $239. Now again, Apple could literally go down to zero, or it could shoot up to infinity. You would never lose more than the $239, all right? Now, with this trade, I think it's a wonderful thing to do because it is non-directional. You don't have to worry about the market skyrocketing or worry about the market going down. And there's really no other way to profit if a stock is going to be range-bound. If you're in a stock, you're not going to make money if it goes sideways. But if it does go sideways in an option with this kind of strategy, that is how you can profit. But I would say, too, when you're putting this on, your main goal is you want to be able to get as large of a credit as possible, right? Because your max gain is going to be relegated to the credit you collect. Mm-hmm. But also, too, you want to make sure that your range is as big as possible while still being able to have a good reward to risk ratio. So if it's too tight, you know, the probability of making money on that trade is going to diminish. So you want as big of a range as possible and still get a pretty fat premium. And to illustrate this thing with a chart, let me show you the kind of range we were looking at. This is what Apple looked like when we put that trade on October 21st. And as you can see on this chart, we have those two horizontal lines, which is outlining our maximum profit zone. So it's kind of interesting.
So anything we should be watching out for here?
You know, you don't really have to watch out for anything. But again, the one thing I would say is when you're putting on an options trade, right? If I'm buying a call or I'm buying a put or I'm doing a bull call spread, bear put spread or whatever, normally I'm trying to find a reward to risk ratio that would be about 3 to 1, right? So you're going to make $3 for taking $1 worth of risk. But when you're doing this kind of trade, you're not really going to be able to see that kind of reward to risk ratio. But normally it's going to be 1 to 1, right? But the reason why this is still a high probability trade is because when you're making a directional trade, you only have one way to win. So since you only have one way to win, your reward is going to be greater. When you have these kinds of non-directional credit trades, right, you have 3 ways to win. So your payout is going to be a little bit smaller, but since you're still getting that 3 to 1 ratio because you are now having the opportunity of profiting in 3 ways, and that's what makes this such a high probability trade. So if you think a stock isn't going to make a big move, you think it's going to trade within a range, I cannot think of a better strategy to put on than one of these Iron Condors. You get paid, you can even be wrong and make money, and if you just do your very first Iron Condor, you'll feel like a pro at this, and you'll impress all your friends too.
We'll take your word for that. And as always, you can check out a text version of this entire option strategy in the options section of our website, accessed off of our homepage at Zacks.com if you're not there already. There's other options articles there for you too. All of the information in that options section is just there to help you know your options. And with Kevin Matras, I'm Terry Ruffalo.